My name is Maurice Thomas, born and raised in San Francisco. Moved down here about 6 years ago to go to grad school at Long Beach State. Any Long Beach State people in the house? Okay, none. That's fine. Anyway, as McKinnon said, I work in healthcare as a data consultant, but I've been a lifelong pursuer of financial knowledge. I've done several of these workshops before, so it's something I'm really passionate about, and hopefully it'll be something that you can get out of it today. So when thinking about your financial life, really, one metaphor that's kind of good to think about is a house, the construction of a house. So we've all seen homes constructed. We've seen the wood frames go up, the roofs, the door, the windows get put in, the carpeting, things of that nature. We've seen that as we've done things through construction. We've all seen that. But the first thing that gets built in a house is a foundation. And for your financial success house, that foundation is financial literacy, knowing the language of money. When people talk money, you want to have your ears open. You want to know what they're talking about, but you've got to know the language. You've got to be financially literate. So that's most of what I'm going to cover today. And there's three main aspects we'll be going through today. First one's budgeting. The second is credit. This class is for credit. It's a little bit more than that, but it's a lot on credit. And the third, hopefully, if we have time, is also investing. So those are the three main topics we'll be talking about today in your financial house. So next slide. So let me just tell you a couple facts or a little millionaire quiz about millionaires in the United States. So for you guys, what percentage of millionaires were born into wealthy families? What would you think? Wrong. Actually, in the United States, millionaires today, only 14% of millionaires were born into wealthy families. Okay? Only 14%. That means the majority of people who become millionaires, some 85%, did it from the ground up, from the low income or middle income families, right? So how much time per month would you think millionaires spend, budgeting or managing money? You probably think they're living a carefree lifestyle, so they don't spend that much time. Well, in actuality, millionaires spend about 5 to 6 hours a month, at least on average, managing their money, including budgeting, talking to financial advisors, what have you. So what percentage of millionaires would you think are retired? Anyone? I keep again with the 40% I hear in back there. No, in actuality, only 20% of millionaires in the U.S. are retired. So that means 80% of the people that you see as millionaires are actually still on their grind. Now, maybe that's not a 9-to-5, maybe that's managing, or maybe they're an executive of some sort, but 80% are still on their grind. And these facts I've got from a book which I recommend that everyone read, The Millionaire Next Door. It's a really great piece about financial education in the United States. Okay, next slide. So as I talked about, the language of money, the literacy, there's some terms you should become familiar with that'll come up again and again throughout this presentation, and again as you go through your financial life. Value. How much money you spend for how much you receive. You always want to be getting at least as much as you're spending, or maybe even more that you're spending. You want to buy things with good value. Your purchasing power. Don't just throw away your money. Shop around. If you're shopping for something, you don't have to buy the first one you see. Shop around. Use your purchasing power. Opportunity cost is a concept basically that says, if I use this dollar to buy X, I could have actually used it to buy Y. So when you spend your money, you have to not just think about what you're buying, but what you could have bought if you didn't buy it on X, right? Opportunity cost. Earning power. So you have the ability to make money today, But you can make even more money in the future if you do things like continue with your education, add job skills, and one of the most important skills to have is one you can practice today, which is networking, right? Most of the jobs, or at least half of the jobs in the United States, never actually are posted. Half of the jobs in the United States are never posted on Monster or Indeed or Glassdoor or any other kind of job site you see. Half of the jobs are never posted. And it goes through networking. People who know people are the people that get the jobs, okay? Half the jobs never posted. All right, next slide. So the first thing we want to talk about today is a budget. A plan for success. So why budget? Budgeting helps you track your spending. It helps prepare for the unexpected. One of the first things when creating a budget is to have money set aside for a rainy day or an emergency. Your car breaks down, your refrigerator stops, your cell phone gets broken. You need money set aside so this kind of emergency won't throw you into a financial disaster, right? So how to stick to a budget? So you have to shop with your budget in mind, not just shop for the things you want. So, you may want to have that BMW, as McKenna said, but you might have to start with a Ford Escort and kind of work your way up to that BMW. There's nothing wrong with that, okay? So a budget is really a plan. So you have to plan your work and work your plan. And more than just a plan, with anything you want to do in life, anything you have dreams to do, for those dreams, you've got to have goals. Goals are great markers on the way to achieving your dreams, right? But a goal without a plan is just a wish. Your goals, if you don't have a plan to achieve that goal, you might as well put candles on a birthday cake and blow them out, because it's just a wish, right? You've got to have a plan. Next slide. So many of you may think, well, if you have a large amount of money, you don't really need to budget. Well, in actuality, just the opposite is true. Let me give you an example. 44%, almost half the people in the US who have ever won a lottery, like $1 million or more in the lottery, that McKenna had mentioned, that my mother-in-law and all of us sometimes play, half the people that have won a lottery in the United States, almost half, within 5 years are broke, right? 44%. So why is that? Because the more money you have, the more people there are trying to get that money from you, right? Believe it or not. Some people wake up with their mind on how to get your money. And as you could see, winning $1 million prize doesn't ensure that. It even hastens it sometimes. So a budget is a way that you know what you're spending your money on so no one can talk you out of it, right? Okay, next slide. So in making a budget, there's really only two aspects: incoming and outgoing money. Incoming money you could call your gross revenue, that's a financial term, the money you made, and outgoing are your expenses. And generally, there's three types of expenses: your fixed, your flexible, and your discretionary. Your fixed is something that never changes from month to month, something like your rent. Your flexible is something like your utility bills, your water or gas for your car that may fluctuate a little bit from month to month. And your discretionary is your fun stuff, things you spend on the movies, Disneyland, not Disney World, Disneyland, clothes, things of that nature, right, that may switch from month to month. Okay, next slide. So here's an example of a basic budget. I don't know if, can you guys all see that? Okay, you can see it pretty well. So you see under the fixed category, we've got housing, auto insurance, cell phone bill, cable, gym. So those are fixed. Those don't really change aren't going to change from month to month. On your flexible side, you've got your groceries. You may want to eat a little bit more from month to month, or you may have a special event, thing of that nature, people coming over. Your utilities, your water, your gas can fluctuate from time to time. And your entertainment, depending upon, your lifestyle, that may fluctuate from month to month as well. So as you can see, this gentleman or lady, whoever it is, I just made up the numbers. So they have 2,500 coming in. They've got 500 in taxes. One thing to always remember is the tax man. A tax man cometh. There's no way to avoid paying taxes. And that's a good thing. Some people say taxes are the price we pay for living in a civilized society. So that's my bit on taxes. At any rate, so you have $2,000 left over. I'll do the math, but the total expenses are about $1,500, and so there's about $450, remaining left over that can be put in like a rainy day fund. So if you guys were looking at this budget, right, and you were trying to cut back somewhere, maybe so you have a little bit of more money left over to do other stuff with, invest, or maybe put towards going to college, things of that nature. Are there any areas on this, theoretical budget that you see you could kind of modify? Anyone see anything? Oh yeah. Eating out at $150 a month, yes. That could definitely be changed. Instead of eating out for $150 a month, what might this person do? Man, go to mom's house. You can always eat at mom's house. I'm almost, 35 years old. If I went to my mom's house right now, I'd get something to eat. That's 100% true. Any other places that we can save money on this budget? The gym, $29. Okay. If you didn't want to have a gym membership, what else could you possibly do to stay in shape other than? An app for the gym? Oh, and you follow the app and it tells you what exercises to do. Okay. Well, I'm okay. I'm a little bit older. I'm not even on. Okay. All right. All right. Okay. All right. Well, that's a good tip. Next slide. I didn't even think about that one. Okay, a couple more phrases or words that'll help you in your financial vocabulary. Cash flow. How much money is incoming and how much money is outgoing each month. Knowing your cash flow is very important to budgeting, because I've had friends who make plenty of money each month. It's just that their cash flow is a little bit off. And let me explain that to you. Say there's a scenario where your bills, right, most of your bills are at the beginning of the month, but most of your money doesn't come until the end of the month. So you may be in a situation there where your cash flow is a little bit off, where you're stressed at the beginning of the month because you don't have any money, but you got all these bills, and your money's not coming to the 15th or the 30th. So in situations like that, actually a lot of times, if you talk to the whoever your bill is from, whether it be your car, your cell phone, insurance, you can actually adjust the day your bill is due to be more in line when you have incoming money. And in that, it'll relieve some of the stress you have from having the bills in a different part of the month than you actually having money. Does that make sense to everybody? Okay. So principal is the amount of money originally invested. So we'll talk about that when we get a little bit more into investing. Capital is money contributed for the purposes of starting a business or investing. An entrepreneur, Let's Act Kenya is actually an entrepreneurial venture. Someone who starts a business or a nonprofit, right? So that's an entrepreneur. Next slide. So some things that, one thing that can help you with budgeting your money is actually keeping your money in a bank. So Wells Fargo, Bank of America, Chase, we're all familiar with banks. but we might not all be familiar with some of the benefits of banks. So one of the great benefits of banks is the money in your bank account is insured by the FDIC, and that's the Federal Department of, I actually had a brain cramp. The Federal Deposit Insurance Company. So the money in each bank account, savings or checking account, is insured up to $250,000. So here's a question to the group. Why do you think the government insures your money in the bank? Why do you think they want you to have your money in a bank? Anyone? Back there. Exactly. So banks can take that money and loan it out to people in the larger economy. That's called the money, it's not up there, but it's called the money multiplier effect. So the bank takes in my $1,000 and lends $500 to this gentleman over here, and lends $500 to this young lady over here, and they take that $500 and they maybe expand their business, which creates more money in the general economy for their employees. Those employees, in turn, who are getting paid more now, go out and buy more stuff, which puts even more money into the economy. So you see how my initial $1,000, if I have it sitting under my bed, it's not going to do anything. But if it goes out into a bank, it goes into the hands of business owners and future homeowners and things of that nature, and it becomes multiplied. So that's the money multiplier effect. And that's the main reason the government insures the money in your banking account, because they want it out there and they want it multiplying. Doesn't multiply under your bed, just gets dusty. Okay. Another thing with banks, one of the benefits is, of course, being able to pay your bills. For those of you that have bills, I'm sure we all have bills of some nature, paying them automatically through your bank account is a lot easier. Also, if you need a check, you can have a checking account, send that money through the mail. So there's lots of great benefits of a bank. Visa just having, wads of cash, right? No one wants to walk around with that much cash. Okay, next slide. So again, these are some of the benefits of savings and checkings accounts. Safe and convenient, checks to pay bills easily. Also, with a debit card, if you use debit cards for most of your purchases, you can track where you're spending really easily that way.